Hey Bowtie Nation, Joseph Hogue here, and we looked at stocks with massive buyback programs in a recent video, stocks to buy of companies returning billions of dollars to shareholders. It's an indirect cash return though, so I wanted to see if we can do better than that, matching the buyback theme up with dividend-paying stocks. I found 5 dividend stocks paying more than twice the market average yield. That means you'll not only get that constant cash flow through the dividend, but also stocks increasing their earnings per share through that buyback and pushing the stock price higher. I'll explain share buyback programs and why it's the perfect combination with dividend stocks later, but let's get started with Comcast, ticker CMCSA, and its 3.2% dividend yield. Now, I know that dividend yield might not set your heart on fire at just over 3%, but with the share buyback programs, these stocks are going to grow the share price and produce the higher total returns for your portfolio. Comcast is a media powerhouse with connectivity through broadband, streaming platforms, its Universal Studios content, and theme parks. And the company is committed to shareholder cash return, growing the dividend by 48% over the last 5 years, the highest dividend growth on our list. In January, the company increased the dividend by 7% year over year and authorized another $15 billion share buyback program. At the current $151 billion market cap, that's almost 10% of the shares outstanding. Now you can see how much a company has spent buying back its own shares as well as dividends here in the Financials tab on Yahoo. If we go to the statement of cash flows and we look under financing cash flows, which shows the cash in and out on debt, dividends, and repurchases, and here we see that Comcast has repurchased a net $11.7 billion of its own shares over the past year. We've still got 4 more buyback dividend stocks to highlight, one with a yield over 5%. But now a buyback or a share repurchase program is just what it sounds like. The board of directors for a company, along with management, determines the cash needs of the company over the next few years. They're going to estimate cash inflows and all the investing opportunities or growth projects management would like to spend on. And if there's any cash left over, instead of having it sit there earning low rates or no rates on money market accounts, they can issue dividends or buybacks of the company's stock. So a stock buyback is similar to a dividend. It's going to be a use of excess cash. But rather than sending that money directly back to investors, a buyback increases shareholder value by increasing the earnings per share. If you think about it this way, if a company reports $100 in earnings over the past year and has 1,000 shares outstanding, the earnings per share is 10 cents per share. Now, if the stock price is $5, then the stock is trading at 50 times on a price-to-earnings basis. That's how much investors are paying for every dollar of earnings, 50 times. Now, if the company buys back 200 shares, dropping the share count to 800 outstanding, then that same $100 in earnings is now 12.5 cents per share. If the stock stays at that $5 a share, the stock is now trading at a cheaper 40 times price-to-earnings, a cheaper PE valuation. Or if the market is still willing to pay that 50 times PE, the stock price increases to $6.25 a share. I'll dig into the research to prove buybacks benefit investors later, but let's get back to our list with Bristol-Myers Squibb, ticker BMY, and its 5.5% dividend yield. BMY is a best-in-class pharmaceutical transitioning into a growth portfolio of pipeline drugs. Total revenue grew 6% year over year in the most recent quarter, while its focused growth portfolio grew 11%, with 12 assets entering registration stage and more than 30 in early stage development. Despite higher spending to develop that growth pipeline, Bristol-Myers has still been able to grow its dividend by 46% over the last 5 years and has repurchased $4.9 billion in shares last year alone, with another $5 billion still remaining in its buyback authorization. One of my favorite dividend stocks is up next, but I want to thank our sponsor for today's video, Fabric by Gerber Life. We talk about investing for ourselves and our future on the channel, but just as important is our kids' future. Because your kids can't invest when they're minors, that means it's all up to you to get them started with a UGMA Kids Investing account. And you can do that in less than 10 minutes with Fabric by Gerber Life. Fabric was designed by parents for parents to make it easy to plan for and manage your family's financial path. With a kids investment account from Fabric, you can start investing in your child's future today. Starting with as little as $1 a day can grow into $10,000 plus, and the gifting feature makes it easier for friends and relatives to contribute. The best part is these UGMA kids investment accounts carry special tax benefits. The first $1,250 income on the account each year is completely tax-free, and the next $1,250 is taxed at the child's rate. And that means little or no taxes each year, and the money can keep growing with compounding returns. Invested funds can be used for education and so much more, like summer camps, club sports, and when they're adults, for their first home purchase or to start a business. There are no contribution limits, and accounts are insured through the SIPC up to $500,000. You can learn more by going to the link here, or I'll put it in the description below. Start investing in your child today. Go to meetfabric.com/Joseph. That's meetfabric.com/Joseph. Back to our dividend list with one of my longest holdings here, Chevron Corporation, ticker CVX, with its 4% dividend yield. And we've highlighted other oil stocks on the channel. For example, Devon Energy offers a higher yield at 4.8%, and Exxon has the higher repurchase program, buying back $20 billion in shares. But I like Chevron for its balanced dividend and buyback, plus its lower cost of production versus its peers. You can see in the lower left graph here, Chevron has one of the lowest operational cost profiles in the industry, meaning even if the price of oil does fall, the company remains a cash flow champion. And that efficiency has meant more cash returned to shareholders and a higher dividend growth. Chevron has increased its dividend payment by 37% over the last 5 years. In fact, the company recently increased its buyback guidance to as high as $20 billion, or about 3 to 6% of the shares outstanding per year, and has repurchased $14 billion in just the last 12 months on its current authorization. Now, the official research is mixed on whether a stock buyback is good or bad for investors. Despite the obvious upside, a buyback does signal that a company is running out of ideas for growth. In theory, investors buy shares to see management grow the company, not just to send the cash back. But the common sense evidence for buybacks benefiting investors, at least in the near term, is there. If we look at the change in shares and stock prices for the largest buybacks in 2020, we see a clear picture here. 7 of the 9 companies decreasing their shares outstanding saw an average increase of almost 10% in their share price, while one company, AbbVie, increasing its share count, saw the stock price decline. And over the decade to 2019, research by Barini shows the companies repurchasing shares beat the S&P 500 by more than 7% a year. Buyback companies saw a 400% return over that period, versus just 280% for those not buying back their shares. And now companies are increasingly turning to buybacks for shareholder cash return. Apple announced its $110 billion buyback program this month, the largest in U.S. history, and the Cupertino giant isn't alone. Total share repurchases by S&P 500 companies are expected up 13% this year to $924 billion and could reach $1 trillion by 2025, according to Goldman Sachs. That would be a big turnaround from the 14% drop last year and continue the last decade's trend. And you don't get much bigger than this next dividend stock, JPMorgan Chase, ticker JPM, the $547 billion banking giant with a 2.4% dividend yield. That is the lowest dividend yield on the list, but also one of the most stable growth dividend stocks you'll find, with the dividend payment up 43% over the last 5 years, and producing a 97% total return, including the share price. JPM dominates the financial sector with the top U.S. bank in retail deposits, credit card insurance, investment banking, private banking, pretty much everything it does, with $3.9 trillion in assets under management. In fact, if JP Morgan was a country, its economy would be the 5th largest in the world. The bank boosted its dividend 15% so far this year after record profits in 2023 and still has nearly $20 billion left in the most recent buyback authorization after repurchasing $10 billion in shares over the past 12 months. Another stock to watch in this theme is the Invesco Buyback Achievers ETF, ticker PKW, a fund of companies that have decreased their shares outstanding by 5% or more over the past 12 months. The ETF buys and sells shares 4 times a year, so it's updated constantly for the companies with the largest buybacks. And while shorter periods may see the market outperform, the buyback ETF has done very well since its 2007 inception, beating the market with a 320% price return versus 271% return on the S&P 500. Now, the ETF only pays a 1.1% dividend yield, about the same you get with the overall market, but you can create your own dividends by using a covered call strategy, selling call options against your shares each month. Either way, you get the dividend yield plus the cash return from that buyback program. Get started on your kids' future with a kids investment account and Fabric by Gerber Life with the link below in the description. Or click on the video to the right to see the how to invest $1,000 for dividend cash flow every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.